Big banks put out and revise gold forecasts all the time. Is this something we should be paying attention to, or is it just a form of marketeering? Vince Lancy's thoughts are next. Vince Lancy joins me today. Vince, thanks for being with us.
Thanks for having me.
Vince, as I mentioned in the intro, we'll be looking at big banks and how they determine their gold forecast. But before we get there, let's pull up the daily gold chart. There's a few bullish factors I'd like to highlight with you and get your thoughts on. For one, the ovals are representing bull flags, and so far they've proven to be accurate. We also have the dark blue line, which represents the 100-day moving average. We're above that line. That's another bullish case here. And finally, we have the 20-day moving average. That's the thinner blue line we see. That's also above the line and also bullish. With all these indicators, Vince, how does the market look set up for you right now?
On paper, the chart looks really good. You have these successive bull flags. You have a nice 2 steps forward, 1 step back situation. And I don't doubt that it could continue, but I do feel that, that something's not right in how the market's behaving. It could extend for a much longer period of time, but I would be more comfortable being long calls or call spreads than being long naked futures. I'm worried about the gap lower.
Vince, what do you mean when you say you're not comfortable with the way the market is reacting?
Well, you know, people try and tie news and information to why gold is higher. The dollar is stronger, that's why gold is higher, because it's a flight to safety. The dollar is weaker, or the one that everyone is talking about now, Syria. Although Syria does have legitimate reasons for driving gold higher, it's not because of the invasion per se. I'm sure there's a little bit of that in it, but I just feel skeptical because of things that have been quoted by other people like marketeering, the way the analysts have gone from bearish to bullish.
Actually, we're going to get to that now, Vince. Last week, we looked at forms of marketeering in the gold spectrum. Do you feel that when big banks put out these gold forecasts, this is a form of marketeering? And perhaps here we should also specify the difference between marketeering and marketing.
To differentiate between marketing and marketeering, marketeering, I guess, would be saying you're a privateer or a pirate, marketeering, privateering. But legitimate marketing is, hey, we have an opinion on this product. We're putting some of our money in it. We'd like you to put some of your money in it because we think it's going to make you money. We treat you like a client, not as a customer, meaning someone who comes once and never comes back. So, you know, marketing and research has its place in marketing. The problem is nobody knows what gold's worth. There's no price to EBITDA. It's a very emotional product, and it lends itself to big swings in emotion, if not price. The problem I have, and this is where marketeering comes in, is that if you rewind pre-ETF, when the public really got involved in commodities on a big retail scale, this research wasn't published daily or weekly. This research was kept close to the chest when it was good, when it was trusted, because the banks used it for their own means. Maybe they would give it to their institutional clients. But the fact that I can read the research, you know, that my taxi cab driver can read the research, I'm starting to feel like the sap at the table, speaking for a retail investor, and I distrust it because it's not based on fundamentals. By fundamentals, I mean valuation. What's it worth?
Well, that's my next question, Vince. If it's not based on fundamentals, what are these reports based on?
I mean, there are fundamentals for gold that can't be denied. The problem is the market doesn't care about them. One example of fundamentals is jewelry demand. Another is production. Those can be talked down as really not that important. The fundamental that matters to me, but is entirely ignored by the market, but maybe it won't be someday, is the reference point of if you were to monetize, if you were to convert all of our dollars into gold, meaning go back to a gold standard, a full gold standard, what would gold be worth? And gold would be worth about $4,500, $5,000. Number one, that's not happening. Number two, it could partially happen, although I'm not calling for it. But the important thing is that's a real reference point. Everything else is technical. It's based on flow. It's based on demographics and demand. And the only thing that I can say with certainty, without picking a price with 2 zeros at the end of it, is that there's demand coming out of China. It will continue to come out, and gold will migrate east. And that's what's happening.
Vince, let's take a look at some of these bank forecasts now. We saw several banks revise their gold forecast downwards back in April and June. For example, Morgan Stanley cut their 2014 forecast from 1450 to 1300. This was after Goldman Sachs and UBS also cutting theirs. But recently, we've seen the banks tend towards more of the bullish camp. Goldman Sachs revising upwards now from 1300 to 1388. SocGen reiterating their very bullish call for $10,000 gold. That's after a market correction that they foresee. But based on your experience, Vince, is it normal for banks to revise their forecast so quickly in such a short time span, such as 3 months?
No, it's not. And it shows either one of three things, maybe more than three things. A poor analyst who really doesn't know what his opinion is and is chasing the market, as so often happens in gold, or a good analyst who happens to see the flow of the market and can reverse on a dime because he sees what's going on. He's tied to the banking desk. Or third, an analyst whose integrity has been compromised by the bank's prop position. So there's my answer.
So Vince, if you had to give me an example of a bank you feel does quick turnarounds before a sell-off, is there a name that comes to mind?
Yeah, well, you could look at any of the bullion banks, and I say this without conspiracy in mind. The bullion banks or the bullion dealers, these firms have information flow that we do not. We see the tip of the iceberg, and the tip of the iceberg could be the gold forward rates, the backwardation, whether they're real or not, but that's information, and they see that information before it happens because they control most of the flow, and now they have their hands in the ETF markets as well. So when you see a firm like Goldman Sachs, for example, let's look at Goldman. You can look at all of them, but let's use Goldman because Goldman made a turnabout in April from bullish to bearish right about the time the market swooned. If you remember, for about a month, once a week you would have a huge sell-off during the LME fix or during the COMEX Open. And you got to ask yourself, was that when Paulson was getting out? Was Paulson convinced to get out? Was Paulson, the weak hand that was forced by Goldman recommendations and otherwise? The actions of the bullion bank, in this case Goldman, from the information that I can see, and there could be information that I have not seen, contradict their recommendation. And, before I say they're committing something illicit, it says right in their client disclaimer, we reserve the right to take positions opposite of what we recommend to you. So it's all right there.
We're running out of time, Vince, but I guess what I'm trying to get to is when these forecasts come out, what do we do? Should we ignore them?
You can't ignore them because it's information. If Goldman says they're bearish and the market tumbles, you have to say to yourself, are they buying from the person who's selling or are they selling ahead of it? You have to determine how the market takes them seriously. Does the market take them seriously or not? Like I sent you a chart with, Goldman's position before and after their recommendation. And it increased by over 600% at the same time Paulson was selling and they recommended bearishly. And then lo and behold, after that, bullish recommendations come out.
Vince, we see bullion bank forecasts that often cause no change in the market. Then sometimes a forecast will come out that will create volatility. What is it about a certain situation that might cause a shift in gold price?
Bullion banks put out research reports all the time, and you're right. For the most part, they're largely ineffectual in the market. But when there's someone out there with an axe to grind or a big position that's on the fence about what they need to do, these reports can have a tipping effect on their decision process. And I believe that's what happened with John Paulson.
Vince, there's obviously a lot to say on this topic, so let's continue it on Twitter. You can tweet me at Daniela Camboni and Vince at Cameron Hanover. Look forward to chatting with you there, Vince.
Thanks. I'll be happy to continue it online.
And thanks for watching this edition of Reset. You can email us at newsfeedback@kitco.com. Thanks for watching.